Today is Tuesday, December 15th, and this is a post-market review for the stock market activities today. What did the market do today? Surprise, surprise, gapping higher in the morning, and for a while it looked like we are going to repeat the playbook from yesterday, gap and crap. And we did indeed crap, at least in the Qs. However, after lunch hour, we started to hear about stimulus optimism and McConnell staying until there is a deal, etc., etc. You combine that with the very low volume and the optimism for the Fed meeting tomorrow and the gambling from the retail side. What do we see? We saw pretty much a grind higher from that point on all the way till the indices closed at the highs of the day. Now, this is quad witching week. So the question is, was today's activities part of the reshuffling from institutions? Perhaps we saw some of that. You saw Tesla being sold off as an exception. However, I don't think we saw a definitive theme, because you could argue that institutions are pouring more money into small caps, and that was the reason why for the rise in the IWM. And it was pretty much computerized buying right after lunch hour. How do you know that? You take a look at the chart from whatever time period you want to look at. 15 minutes, 5 minutes, and you will see the same quantity of buy volume, one after the other. That tells you it is a buy program from institutionals that was executed to buy the IWM. So what does that mean? Should we go and pour more money into the IWM? Not really, because on the other hand, you had Apple rising by the tune of over 5% for the day. So was there institutional money being poured back into the FANG stocks? We don't know yet. We are still on Tuesday. There are 3 more days of activities. We will start seeing more and more in a clearer pattern what institutionals want to do during quad witching week. But today also we saw another illustration of what's wrong with this current market. For example, exhibit number 1. We heard the news in the morning that Norwegian cruises are raising about $500 million in new capital debt, meaning issuing more shares. Now, typically, in a rational market, that would be a negative sign, and investors will sell the name. Not in 2020 and the Robin Hoodiot land. They actually decided to buy Norwegian cruises, and you saw the name closing well above the lows of the day. The company said we're looking for suckers to issue more shares to. The Robin Hoodiots raised their hands and said, we're available. Here is our money. And exhibit number 2 to what's wrong with the market. I don't know if you caught this in the morning or not, but there was a very popular Robin Hoodiot leader on Reddit, and his recommendation of the day, the ticker that he feeds to the zombie crowd every morning, was GameStop. And this trade caught a lot of attention on Reddit, as much as it was featured on CNBC in the morning. Jim Cramer was talking about it in the morning. So if you wondered why GameStop gained about 10% for the day, here is your answer. No, there was no news, no catalyst whatsoever. This is what's leading the market now. It is retail gambling participation. You got a little taste of what could go wrong when retail participation goes off the charts, with the IPOs of DoorDash and Airbnb not performing so well since the IPOs last week. But we do have a market to cover here. We have interesting trades in the options market, interesting headlines. We will cover the usual charts, but stick around for the conclusion, because this is the most important part. We have the Fed's meeting tomorrow. We've already pumped the market pre the meeting of the Fed. What are the implications for whatever decision the Fed will take tomorrow, knowing that we already have the vaccines, the market's already trading at all-time highs, we're seeing certain economic indicators recovering and holding steady? We will talk about that. But hint, hint, remember, this market is a cocaine addict, aka fiscal and monetary liquidity addict. And this is why the market performed very well under an environment saturated with bad and negative news, because bad news mean more fiscal and monetary stimulus. What happens now that we have some good news? We'll talk about that in the conclusion of the video, but for now, let's cover the market. And here we go. The diamonds closing big in the green by 337.76 points, or a gain of 1.13%. The Nasdaq also closing in the green, reversing the early declines and weakness we saw in the session, closing about 155 points even, or a gain of 1.25%. The S&P 500 is no exception today, closing in the green, 47.13 points, or a gain of 1.29%. And here are the sector's performances. And notice the theme that is going on today. We saw a decline in the US dollar because we saw a gain in the British pound. Why is that? Remember, we have the stimulus optimism here in the United States. Over there in Europe, they have the Brexit talks, and they keep talking, delaying and pushing the post further away every single day. But as long as they keep doing that, the market will still cling into the optimism that someday we will have a Brexit deal and a stimulus deal here in the US. And that is what's been fueling the market for weeks now. But today, the optimism reached highs and we saw the dollar declining. What are the implications of such move? Right away, you see the sectors that will benefit the most from the decline of the US dollar leading the market. At number 1, capturing the gold medal, basic materials. At number 2 for the silver, energy. Number 3, rising from the dead and catching the bronze medal, utilities. The laggards of the day, consumer defensives, communication services, and healthcare. But no shame here, because every market sector managed to close in the green. Moving on to the futures market performance for the day. Right away, we see crude rising a little above 1%. Meanwhile, in softs, we saw positive day for cotton, OJ, lumber, and sugar. The laggards of the day, coca and coffee. Big day for metals. We talked about the decline in the US dollar. And right away, you see that the British pound is rising above 1%. That was a massive move for the day. And right away, it shaped the entire trajectory of where stocks are going to trade before the bell even rang. Gold closing over 1% in the green, silver over 2%, platinum almost 3% in the green. The laggards of the day, copper and palladium, yet closing in the green. However, nothing near gold, silver, and platinum. Moving on to meats. Muted day for live and feeder cattle. However, the gains in lean hogs continue for another day. What about grains? We saw more activities here in soybeans, closing in the green. Soybean meal, closing over 2% in the upside. Corn, wheat, canola, pretty much muted, yet closing in the green. We saw declines here for rough rice and oats taking a break. By the way, I've been bullish on oats for a while, and you saw the massive movement in oats. And here is a confirmation. Meghan Markle, I don't know what you call her. Princess, Duchess, Her Highness, Her Lowness, I don't know. Whatever she is now investing in oats. Specifically in oat milk latte startup Clever Blends. How do you participate in the upside for oats if you don't trade futures, you might ask? I gave you the answer a few days ago. The name is Sun Opta. This is the largest oat milk producer in the US, and the stock is trading around $9, so it could be the new retail crowd's favorite. We need a bunch of Robin Hood's leaders on Reddit to push this name, and you will see it exploding higher. Moving on to the big casino, the options market. Let's see what's going on here today. The most active tables at number 1, and this is a mammoth volume. You wonder why Apple is trading 5% in the green? Here it is. 3.3 million contracts. This is equivalent of over 300 million shares in Apple in notional value. Over 80% of those were calls. Massive activities. When you see something like this, it creates a gamma squeeze. There is no way you can stop it. There is no rationale behind fighting it. What do you do if you're an Apple shareholder? You take advantage of that by selling upside calls so you can raise some cash from selling all of that credit. because the premiums get elevated in price right away. Yesterday they were dirt cheap. Today they have doubled, tripled in value. They're getting expensive as we see more gambling activities in the Apple table. Here is number 2, Tesla. A little muted when you compare it to previous days, only about 700,000 contracts for the day. About 63% of those were calls. And we see AMD at number 3, and they've been trying for a couple of weeks now to push this name over the 100 price target. It is an important psychological level, and it becomes like a magnet right now that AMD would reach 100. They will try to push it. They tried for a couple of weeks unsuccessfully. They're giving it another shot this time around. And we see over 640,000 contracts traded today. About 81% of those were calls. And check out the Palantir table. Not so hot so today. And it is no wonder Palantir declined about 3% for the day. The gamblers shifting from Pfizer, Palantir, back into Apple. This is the market mentality these days. They want to know what's going to happen tomorrow in the market. They want you to give them a bunch of tickers, a bunch of puts, a bunch of calls to follow, and that's it. Lazy investing is winning in 2020, of course, until the rug gets pulled off the feet of the market. In this channel, we could be right now, this moment, having thousands of subscribers if we don't talk about the macroeconomics, the sentiment indicators, and all the warning signals in the market, the bubble indicators. If we just stick to giving people tickers and trades, this channel would have grown tremendously, but I'm playing the long game. After this show is over, 99% of all of these traders and YouTubers would disappear completely. But here it is. I gotta feed you somehow and give you some interesting trades and unusual activities in the options market today. Starting with AMD. This is a massive trade. You cannot ignore it one way or the other. For New Year's Eve expiration date, and they're buying the 108 calls. Expectation, of course, that AMD will rise over 11% by then. And the overall value of the volume traded today coming up about 1.5 million bucks. Here is another interesting one for the Qs. They're buying protection here, the 235 puts. And this is very interesting. This trade is extremely interesting because they're buying insurance way out of the money. Buying the 235, expiration date January 29th, with expectation that the Qs could decline over 23.5%. Again, it is a pricey trade costing over $500,000. But this is how these big institutions and big professional traders hedge against their current positions. And here we see that the bullishness in semiconductor names continues. And the ticker here is TSM, Taiwan. They've been betting bullish bets on this name. It is amazing that there are no bears for this particular name. Seldom when you see put options activities for this name, seldom when you see somebody wants to sell this name. And this is why it is no wonder that TSM been grinding higher and higher and higher all year long. There is no resistance whatsoever for this particular name. And in this case, they're buying the 115 calls, expiration date New Year's Eve, with expectation that the name will rise over 10% by then. And they're paying also over $500,000 for this trade alone. Here is an unusual one for real estate, IYR. The ETF for real estate. This time around, they're buying puts, the 79.5. Expiration date New Year's Eve, with expectation that the ETF will decline over 6% by then. And here is a notable one for Microsoft. Remember, Microsoft been dormant. The majority of FANG names been doing nothing. We're talking about Microsoft, we're talking about Google, we're talking about Amazon, we're talking about Apple. They've been consolidating since September. But you're seeing that Apple is starting to rise from the dead. The trader is making the assumption that Microsoft's turn will be next, and we will see a rise in Microsoft shares. In this case, they're buying the 232.5 calls, expiration date January 29th, with expectation that Microsoft will rise over 8.5% by then. Again, this is a very pricey trade, costing about $3 million. And here is another interesting one for TAN, the ETF for solar. And they're buying the 100 calls, expiration date New Year's Eve, with expectation that the ETF will rise over 7.5% by then. Again, it is a pricey trade costing about $1 million. And the last one we're covering for the day for Penn National, the ticker PENN. Another bullish bet. They're buying the 90 calls, expiration date New Year's Eve, And it is a big one because it is costing in total volume over $1 million. Of course, for the trade to be profitable, you need Penn National to rise over 8%, well over 8% by New Year's Eve. Moving on to the headlines that shaped the day, and right away we heard some macroeconomic data. The Empire Index, or the Fed New York Regional Manufacturing Index, showed weakness in September. What are we talking about here? The index came at 4.9 for December. The estimate was 6.2 and the last reading was 6.3. So it is a massive mess for the Empire Index today. Don't worry about it. Stocks only go up. The macroeconomics data means nothing. And here is more useless data for you. U.S. Import Price Index edges upward in November. What does that mean? Inflation rises. Are you even feeling the warning signals here? Economic activities down, inflation rising, meaning that we have a bad rise in inflation, not a good one. What does that mean? A good rise in inflation means a rise in wages and economic activities. But when you see inflation rising with a slowdown in economic activities and lower wages, that is not good because it is a recipe for stagflation. Again, who cares? Stocks only go up, right? But here is more. We heard more macroeconomics data in the morning for the industrial output, and it came a little light here, much lower than last month reading. However, we are technically still in expansion territory. But take a look at the blue bar chart right in front of you. You see the recovery in the second quarter right away from the massive dip, and now we are starting to trend lower. Another sign for concern here. And I would leave it to economist Mohamed El-Arian to explain to you why the macroeconomics data that we heard in the morning are a source for concern. Here is the tweet. This morning's manufacturing data are a further indication of the loss in momentum of the U.S. economic recovery. November industrial production expanded by 0.4% compared to 0.9% for the prior months. More concerning, the December Empire Index fell from 6.3 to 4.9, also missing consensus expectation. But hey, what does he know, this guy Mohamed El-Arian? What does this loser know about the stock market and economics? He only consulted presidents, prime ministers, and one of the top economists in the world. But hey, the Robin Hoodists know better. And I know what you're gonna say. You're gonna say, but the Fed, the printing, Jerome got our backs, bro. Jerome might actually stab you in the back tomorrow, so watch out for your overconfidence in Jerome, because Jerome can support the market to a certain level, but he's not responsible for the gambling mania led by retail. That's on your own. Creating the bubble is sure on the Fed's lap, but pushing the bubble to outrageous levels, that is on the lap of retail moron investors. Just be aware of the fact that insiders are already selling and liquidating their positions. And here's probably what led the automated rally in the markets today. We saw a decline in the Qs. We saw a little bit of weakness in the early hours of the morning. Sure, we gapped higher, but we started seeing the indices starting to lose some momentum until we started hearing more news about stimulus. The Speaker and Treasury Secretary Mnuchin spoke at 5:30 p.m. tonight, meaning yesterday. This was after the bell, yesterday, by phone for approximately 22 minutes on both the status of the talks on COVID relief and remaining open items on the omnibus. This guy's trying to be cute using these fancy words, omnibus. What's wrong with the agenda, the table, whatever? But anyways, we heard more news about stimulus. Pelosi, Mnuchin discussed COVID-19 relief spending bill. They talked for 22 minutes yesterday. They talked again in the morning. I don't know what the hell they talk about. They've been talking to each other like a bunch of high school sweethearts. 50 minutes at a time, 20 minutes at a time, and still they cannot agree on something. But this is perhaps what moved the markets to the upside today significantly. McConnell says won't leave for a year without a relief package. Well then, Mr. McConnell, you can just sign on the bill and go home. But he prefers to fight. He prefers to be an obstructionist here because he takes his orders from the donor class. The donors are telling him, Mitch, do not agree on any stimulus bill until and unless It includes liability protection so we don't get sued. Furthermore, the donor class don't want to reward blue states such as California, New York, because they want to punish those states. They see them as being aggressive with the lockdowns and pretty much creating a self-inflicting injuries that the federal government should not be responsible for. So this is the sticky issue. But again, remember, we had bad macroeconomics news. That doesn't matter anymore. Fundamentals don't matter. What matters is the cocaine, stimulus optimism, and vaccine optimism. Today, we had a trifecta of these market supporting factors. We heard about the stimulus, more optimism, and we have more cocaine tomorrow. That's the assumption, at least, whether it's right or wrong. But rest assured, today, we also sprinkled a little vaccine optimism on top because Moderna's COVID-19 vaccine is highly effective, quote unquote, said the FDA, setting up a second coronavirus shot for U.S. authorization as soon as this week. The vaccine buffet is being set up right now. We got Pfizer, Moderna is on the way. However, Moderna shares traded lower today and the Robinhoodites were caught by surprise. They bought Moderna call options yesterday because we knew that the panel is going to approve and recommend the emergency authorization for the Moderna vaccine today. What happened? They're asking. What happened to my call options? We had the good news that we were looking for. Welcome to a phenomena called sell the news. You might get introduced to it again when we pass the stimulus tomorrow. Just a little hint, a little something you gotta keep in mind. And here is more vaccine news for you. Pfizer CEO says that he will wait to get the COVID-19 vaccine because he says that company executives should not be cutting the line. Oh, that is the reason. Such a noble, ethical person, this Pfizer CEO, right? But somehow he did not feel the same urgency for ethics when he decided to dump 60% of his stock right after the announcement of the vaccine development from his company. Oh, and by the way, I conducted a poll on my Twitter page. There's still time to vote if you want to, asking you which vaccine will you take once they're available to the public. So far, the Pfizer vaccine coming up at number one, with over 40% of you saying that you would take the Pfizer vaccine as your top choice. Moderna at number two with 24%, and the third option is none. I'm not taking any vaccine. That is 19%. AstraZeneca coming up last with 17%. I don't know about you, but the behavior from the executives of Pfizer and Moderna is a little concerning. I much rather wait for the Merck vaccine because at least the CEO of Merck has been very ethical, very honest from the very beginning. He did not dump shares until recently in November, just one time, but from the very beginning he's been straightforward, saying that the development of the vaccine has to be proper and it has to take its time. And he also mentioned that we will be wearing masks all the way till the end of the second quarter of this upcoming year at least. So I feel more comfortable with the Merck vaccine. Now, I have no reason to doubt the efficacy of the Pfizer and Moderna vaccines, but I find that their executives' behavior is a little too shady. Moving on to consumer sentiment news, let's see what's going on. Right away, we heard about Bank of America Fund Manager Survey. We had a lot of information about it today. Here is some of the information. The most crowded trades. Number one being long technology. That was 52% of all trades. Number two, short the US dollar, 17%. Number three, long Bitcoin, 15%. But here is the piece that was alarming to a lot of people this morning, and it is a sign of alarm. You gotta take it seriously. Here it is. Latest Bank of America survey shows fund managers are underweight cash for the first time since May 2013, with levels down to 4%. They are the most bullish on stocks and commodities since February 2011. Everybody's bullish right now. Even perma bears turned bullish. Remember that. But here we have the threshold. When we reach 4% cash, that is a sell signal, according to Bank of America. Did we listen to that today? Not really. We continued to buy stocks on blindfold. Oh, and by the way, if you feel that you're missing out on the IPOs of Airbnb and DoorDash because they came more expensive than you expected. Here is a new one coming up early next year for the chopper service, Blade, and they're going public via SPAC. Surprise, surprise. What is Blade, you might ask? It is a chopper service for the rich, for them to be transported from Manhattan to the Hamptons back and forth. Let me issue my prediction right here. I think that this company will IPO at about, let's say, $150 billion because it is the future, bro. All of us who are doing Robinhood and we're just putting a blindfold and buying stocks, we are rolling in cash. We're richer than ever. And soon enough, we're going to become part of the 1% ourselves, right? And we're going to need the chopper service to be expanded to accommodate us. You see what I'm seeing here? Very smart thinking. Oh, and did you catch the interview in the morning with Warren Buffett and Goldman Sachs CEOs? They were talking about small business on CNBC. Warren Buffett called it a war against small business, and he urged Congress to pass the stimulus immediately. And you saw right away McConnell saying that he's going to stay until a stimulus is passed. He's not going home for the Christmas vacation until the stimulus is done. All it took is one billionaire speaking up, and there you go, Mitch is already going on his knees. We need more billionaires to talk tomorrow, and the stimulus will be passed right away. But here is a Goldman Sachs CEO saying that the IPO market, quote-unquote, euphoria is not healthy. And if you watch the entire interview in CNBC, he mentioned quote-unquote 1999 quite a lot during the interview. So even Goldman Sachs CEO slipped and could not hold it back because this is the reality of the market sentiment and conditions right now. And here is more data for you about market sentiment. S&P 500 trading near 29 times earnings. In 1999-2000, we saw the PE's ratio above 30. We're getting very close here to go back to the dot-com bubble territory. Now, in terms of price to sales, we've already trading above the levels we've seen during the dot-com era. And please, I'm not trying to scare you by presenting facts and real data. I'm not trying to do that at all. Who cares about real data and facts and macroeconomics? That doesn't matter. Take them with a grain of salt. I don't want to disturb you. Keep your blindfold on and continue to buy until you say bye-bye to your gains. Oh, and here is the last piece about market sentiment that I got for you today. This is Mark Budd from Caltech, and he says about quantitative easing, quote-unquote, and he is quoting, by the way, Charlie Munger, who's the alumni of Caltech, and Berkshire Hathaway's leading man. And Munger says, we are in very uncharted waters. Nobody has ever gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we are. We are very near the edge of playing with fire. This is Charlie Munger saying this. But I know, what is Charlie Munger knows? He's too old. He's a dinosaur. He doesn't know how to invest anymore. We, the Robin Hoodites, we are the new Charlie Munger. But the original Charlie Munger, what does he know? He's just one of the most legendary investors of all time and one of the smartest people that ever lived. But we, the Robin Hoodites, we are more legendary than Charlie Munger because we beat his ass this year, and we are the smartest people in the world right now. And here is the last bit of news I got for you, and it is corporate news for Apple. And the Nikkei says that Apple plans 30% increase in iPhone production for the first half of 2021. And the market right away assumed that this increase in production is to meet the increase in demand. I showed you the data, the survey from CNBC, where over 40% of Americans say that they will spend less this holiday season. I showed you the data, the facts before, that over 60% of Americans are under the threat of eviction, that they're behind in their mortgage and rent payments, and they are behind on their bills. I showed you the data, the facts from JP Morgan, where the credit card usage from consumers has not recovered to pre-pandemic levels. The reason reason is the consumer is very weak and very concerned about adding more debt to their already existing pile of debt. Meanwhile, somehow Apple is seeing some surge in demand and they're responding by increasing their production targets. Something is very fishy about this story, and we will find out the facts very soon. But perhaps the explanation right now, since the 1% is doing better than ever before, they will splurge and compensate Apple for any losses of sales that come from the average bum American who's waiting on food lines. The which, instead of buying one iPhone this year or two iPhones this year, they will buy 100,000 per person just to compensate Apple for all of the loss in sales due to the weakness in consumers. Moving on to the heat map analysis, and what do we see here? It is a sea of green, a tide that lifted all boats, a trifecta of events. Vaccine optimism, cocaine optimism, stimulus optimism, and you see that everything traded higher today. The reopening trade, the stay-at-home trade, the IWM, the Qs, the SPY, pretty much every ETF in the market. There are few exceptions though, so let's go through them right away, starting with tech. You cannot help but to notice that the big box of Apple is lighting bright green because it has risen over 5% for the day. Meanwhile, the big box of Microsoft piled in comparison with Apple. Now, let's do a little bit of psychology for you. When market participants look at this map, and they see Apple lighting up bright green. Meanwhile, Microsoft is actually trading in the red today, closing very muted. They have FOMO. They missed the move in Apple. Apple options are expensive now. What do? They move to the other big box of Microsoft and they try to repeat what happened with Apple in MSFT. So I expect this name to rise from the dead as well. One way or the other, up or down. But Microsoft is not going to be muted forever here. What are the biggest winners in the technology sector today? Right away, we see ASML in semiconductors up over 3.5%. AMD is a big winner today. TSM. However, Nvidia remains very muted. It doesn't want to move. It is a sleeping giant, a big winner for the year, but it's been doing nothing since September. Another potential for a move here in Nvidia. We saw gains for Square, Oracle. However, we saw a little bit of weakness here in the software names. ServiceNow down about 1%. And we saw names like Zendesk, Datadog, Salesforce all closing just slightly in the red. What about communication services? The big boxes of Google and Facebook muted, up 0.5 percentage point apiece. But we did see a resumption of the gains for Disney, up about 3% or so for the day. Zoom remains muted but trading in the green for the session. Moving on to consumer cyclicals. What do we see here? Similar story with Amazon. Muted, not doing anything for the day. And the question here, or you might have heard it in the media, are we going to see a rotation back to the FANG names? One of them risen from the dead today, Apple. Are we going to see Amazon, Facebook, Google, Microsoft next? That is the $1 million question. It depends on quadruple witching. What are the big shots doing this week? But we saw a very decent day here for consumer cyclicals. Wayfair up, casinos up, cruises, hotels, restaurants, apparel retail, all closing with massive gains. What about defensives? What do we see? Muted picture all in all, but we did see notable gains here for STZ, consolidation brands, and we saw a recovery for Ambiv rebounding over 2.5% in the green. The biggest loser of the day, Tyson, down over 2% for the session. What about REITs? REITs are performing a lot better today, specifically residential, healthcare facilities. You saw Welltower closing over 4% for the day, massive gains. Even retail, you saw Simon Properties closing over 2.5% for the session. Moving on to utilities, even utilities managed to close in the green today. Can you imagine that? Big gains for Dominion Energy, Southern Company, Next Era Energy, Duke Energy. But the biggest winner of the day by far is Exelon Corporation, the ticker EXC, closing in the green over 4 percentage points. Basic materials. We see the dollar declining. Metals do and perform very well. Gold miners up. We see Newmount up over 2.5%. Barrick's Gold up almost 2%. And we did see copper rebounding today. Freeport McMoran over 2% gains for the session. The Brazilian miner Vale also closing over 1%. We saw massive gains here for chemicals, specifically DuPont, the ticker double D, closing almost 3.5% in the green. Moving on to energy, the weakness in Chevron remains very notable here. Chevron is underperforming Exxon by a lot for weeks now. What's going on here with Chevron? Well, we see BP closing almost 3% in the green, Kinder Morgan rebounding almost 3%, Occidental Petroleum rebounding from the losses from yesterday, 3.5% in the green. What about industrials? Massive winner today. However, the defense names were muted. Boeing, Northrop Grumman, Raytheon, Lockheed, all muted, did not do anything. What outperformed today? Airlines, Caterpillar, Deere, General Electric, Eaton, and my favorite, Emerson Electric, over 2.5% in the green. What about healthcare? Massive gains for Eli Lilly, over 6%. We heard the news in the morning for more M&A activities in the pharmaceutical giants, specifically this time Eli Lilly. Bristol Myers also closing massively in the green, over 4%, but we did see Pfizer being very muted. Similar story with Moderna in biotech. Money's coming out of Pfizer and Moderna. The pump is done. We know the vaccines are out. They're already being distributed. The question is, who's next? Is it going to be Johnson & Johnson? Is it going to be Merck, which has been doing nothing? A sleeping giant here. Keep an eye on Merck. We saw Regeneron giving up some of the gains from yesterday, but the notable winners for the day were in medical devices. We're talking about Medtronic, the ticker MDT, closing over 2.5% for the day, and Boston Scientific, the ticker BSX, closing over 3.5% for the session. Moving on to financials, massive day here due to the rebound in yields on stimulus optimism. Wells Fargo is becoming a retail crowd favorite, closing almost 4% in the green. Please remember that this name is in trouble, not according to me, but according to the Federal Reserve. Yet the retail crowd continues to buy Wells Fargo and Citibank, the weaker names in banking, but we saw JP Morgan, Bank of America, also closing in the green by the tune of over 1.5% today. Regionals rebounding from the losses yesterday, so did Morgan Stanley, rebounding and adding more gains. For Morgan Stanley, over 3.3% gains for the session. Goldman Sachs, also a decent session here, closing about 2% in the upside. What about credit services? A little muted here, but the notable outperformer is American Express, the ticker AXP, closing about 1.5% in the green. Moving on to the rotation trade, what do we see here? There is no theme. Today was the tide that lifted all boats. The trifecta of optimism hitting the market. Combine that with retail participation. Combine that with a pump overnight. Combine that with computerized buying after lunch hour. And here is the results. Pretty much every name trading in the green. There is no theme whatsoever. We see massive gains here for Peloton and Apple in the momentum stay-at-home stocks. And by the way, we have replaced Clorox with Zillow. The reason is Clorox, since I shorted the name, went down over 20%. It is no longer a momentum name. It is no longer a stay-at-home play. The pandemic is pretty much coming to an end. So we are replacing Clorox with Zillow. What about across the aisle for the comeback stocks, aka the reopening stocks? We saw massive gains. Cheesecake Factory over 5.5%. Similar story with Six Flags, Disney, Southwest, MGM Grand, Marriott, TJ Maxx, Live Nation, all closing with massive gains. Lagging the day, Planet Fitness down almost 4%. Again, Planet Fitness could be an exception here. If we see a shutdown in New York, this name will get hit hard. What about Royal Caribbean? Pretty much muted. We heard the news about Norwegian Cruises issuing more debt, and that took a toll on all the cruise line names. However, they were much lower earlier in the session. The retail crowd ate the bag of shit and bought these names, pushing them higher, closing pretty much flat for the day. With this kind of market sentiment, I don't understand why more companies are not raising more debt and issuing more shares. They should be doing that and taking advantage of the stupidity of the retail trader. Moving on to the charts analysis, what do we see here? For the SPY 15 minutes perspective, we have a new pattern for you. The greedy pig, smiling pig. You see it right away. Yesterday, we gapped higher, flushing down. Today, we said never mind. we're going back where we gapped higher yesterday. All in all, making this smile pattern. But all jokes aside, we do have a new resistance level, so grab your pencils, whatever you want to do, because the market has spoken. This level is appearing to be very significant for the market due to several points of reactions, going all the way back to September. What are we talking about here? 369.60. That is the resistance level right now. We closed pretty much at the resistance level, so we have to see what happens tomorrow. The likelihood is if we see another overnight gap, we will defeat the resistance, and we have to look for all times highs. What do we see here from a daily perspective? Today, we did a lot of repair to the technical damage from last week. You see the RSI starting to curl upward. The MACD indicator starting to curl upward. Today, we closed pretty much at the highs of yesterday's candle. That is bullish momentum and activities. But remember, we have important events coming up. Quadruple witching, the Federal Reserve, all bets on the table here. Do not pop the champagne too early. That is the message of the day. And by the way, the reversal candle from last week, the highs of that candle will remain to be a very strong point of resistance, meaning that the SPY will have a hard time closing at all times highs without a massive gap higher overnight. Moving on to the Qs, 15 minutes perspective. What do we see here? We're not seeing the smiley pig pattern, but we've seen the swoosh pattern. The Qs open gapping higher, just like the rest of the market. However, we saw a massive slide lower in the earlier hours of the day due to a mini sell-off in Tesla. And this is the suspicious activities here. What are they doing with Tesla? Are they going to start dumping the name? Are they going to buy it? Today we got a little taste. We saw some market participants dumping Tesla shares early in the morning. However, just like the rest of the indices, after lunch hour, after the good news about optimism for the stimulus, we saw computerized buying all the way to the end of the day. What about the Qs from a daily perspective? What do we see here? We did a lot of repair here from last week's reversal candle, but we are not at the highs yet. That level will remain to be very sticky point, very difficult level of resistance to crack until and unless we have a gap higher. That is the only thing that could push us above all times highs. Moving on to the IWM. 15 minutes perspective, what do we see here? Gapping higher, just a little bit of a sell-off during the first 15 minutes or so. After that, the IWM continued to march higher and higher and higher with no stop in sight. Very little resistance, low volume, computerized trading. Retail picked up the gap higher in the morning, and then you saw the computerized trading from institutionals coming after lunch hour, and the IWM closing very strongly all times highs. What do we see from a daily perspective here? I'm showing you a weekly chart for a reason. Look at the divergence from the 20 weeks moving average. We have never seen the IWM diverge in this manner from the 20 weeks moving average. I call the 20 weeks moving average the king of all market indicators, and it is the center of gravity for any chart, meaning that you cannot diverge from the 20 weeks moving average in an extreme fashion, up or down, without having a very significant reversal to correct the technical divergence going down to revisit the 20 weeks moving average. Now, there are certain instances where a chart pop higher, a gap higher for earnings reason or whatever, but then it grinds in a flat trading style for weeks and weeks to allow the 20 weeks moving average to catch up with the move in the stock. Different story here for the IWM. The IWM is not taking any break to allow the 20 weeks moving average to catch up to the chart, meaning that this chart is looking very, very unhealthy right now, and it is susceptible for an extreme correction. So watch out here and proceed with caution with the IWM. The technicals speak volume and they never lie. They always work out. Just give them time. You cannot be doing this in a healthy chart. And I know what you're saying already, but save your butts. Back in August, we saw the same thing for the Qs, diverging higher from the 20 weeks moving average in impulsive movement week after week. What happened? A big correction, double digits correction. The same story will happen in the IWM. What does that mean? Should you go right ahead and short the IWM? It depends. You did not see any reversal signal yet. The IWM is showing extreme strength, but my guess is it will break down in overnight gap down, because the more extreme you go to the upside, the more extreme the correction is. But playing God and trying to short ahead of time could come with a lot of risk. So the key here is to give yourself plenty of time. If you have the FOMO and you want to short ahead of time, you have to give your puts a lot of time, enough time to work out. Otherwise, wait till the reversal signal, wait till we see a confirmation of the reversal, and then hop in the short ride. There is going to be plenty of meat on the bone for you. Moving on to the Dixie. What do we see here? The Dixie is looking weak today, giving up a lot of the gains in the last few days due to the rise in the British pound. But again, we are in very volatile territory here. If we have bad news about Brexit, bad news about the Fed, anything regarding stimulus, the dollar will move one way or the other impulsively. Higher if we have a fallout in stimulus, fallout in Brexit, fallout in the Fed's announcement, that will send the dollar index higher due to short covering. Absent of that, we are at a critical level of about 90.5. And tomorrow pretty much could be judgment day for the dollar index. Breaking below 90.5 will send the dollar index flushing down significantly. And perhaps that would come hand in hand with some news with the Fed or passing the stimulus, etc. So tomorrow I would characterize the day as put up or shut up for the dollar index. What happens when the dollar index slides lower? Gold rises. And we had news today about the rise of inflation on the import price index. What do we see in gold? Massive move to the upside. Now remember, I entered the trade at 1800, sold half of the position at 1870, the resistance, still have half of the position, and my hope is that we can grind all the way higher in gold to the level of 1925, and then I will exit the position altogether. However, we are still in no man's land here. We're waiting and waiting and waiting on the outcome of stimulus, Brexit, and what the Fed is planning to do. Everything could be erased tomorrow. The entire move in gold could be flushed down and erased entirely tomorrow, depending on the outcome of what the Fed is trying to do. So right now, I'm not buying, I'm not selling, I'm not doing anything. I'm just staying still. Moving on to yields. What do we see here? And I'm leaving the bullish case and the bearish case markings on the chart. The double bull flag and the double top. Today we saw a rise in yields. Good news, meaning the yields rising higher. And we're waiting and waiting and waiting for the moment the yields rise to 1%. That would be an important milestone for the stock market. And again, remember, we're looking for what is going to spark the correction here. You're hearing analysts all over television saying that the market is overheated and anything could crack the market right now. We are looking for the spark. What is it? Is it yields rising to 1% will freak out the market? Is it tomorrow? If the Fed announce canceling, or for lack of better word, stopping the temporary lending facilities, ending them, that could be the spark, or fallout on stimulus, although that is not likely. But we'll talk more about this subject in the conclusion of this video. For now, let's continue with charts. Moving on to the VIX. What do we see here from a daily perspective? Today the VIX slid down significantly, over 7%. You know what happened. When the market rises and grind higher and higher in a muted fashion throughout the day, computerized trading, that means death for the VIX and death for your put options. But we are still elevated here in the VIX. From the important level of 20, we are now trading at around 23, so the VIX could give it another shot and try to crack the level of 25. Again, we are on edge. I'm not making any move today. Matter of fact, for the entire week, because quadruple witching, because the Fed, because the outcome of stimulus, because the outcome of Brexit, everything could change in a moment. Moving on to Apple. What do we see here? This is a weekly chart, by the way. Remember, a few weeks ago, we talked about the bullish formation of the bull flag in Apple. And I mentioned to you that Apple chart is starting to show a lot of momentum and strength, meaning not only you're having the bull flag formation, but you have a series of higher lows. You also have an RSI indicator that is starting to gather more momentum. You have a crossing at the MACD, and you saw right away Apple gaining for 3 weeks in a row right now. Now, what is the bearish thesis against Apple, by the way? Here it is. We are forming a bear flag formation all in all, and the highs from September are going to be very, very difficult to crack above. You will need a lot of momentum and a lot of rise in volume to reach all times highs. We're seeing a rally in Apple, but we're not seeing it on high volume, and we are still far away from the highs of September. So it is too early here to assume a bullish position in Apple right away. The bull versus the bear argument. The bulls are winning right now this week. For the last few weeks, we will see what happens next. What about Tesla? What's going on here? This is a daily chart. Today, Tesla was muted, pretty much weak, went down, but it climbed right upward, however closing in the red all in all. We're seeing a mini crossing here in the MACD indicator, a divergence lower in the RSI, but technically Tesla still has a lot of room to climb higher. I told you the name could climb all the way to 700. And my line in the sand is the RSI level of 84. I am not going to short this name significantly until we reach 84. If it goes down without me, that's fine. I missed the boat. I will wait until the chart reaches the lower trend line and take it from there. If we see more weakness breaking the trend line, then that would be another opportunity to short. Other than that, I don't want to jump the gun with Tesla because it is an expensive name. And if you get it wrong, you will get burned very severely. Right now, I have some put options in Tesla, but they're not a significant investment. And I gave the example that I'm shorting Tesla with one pinky. But if we go to the RSI level of 84, I will be shorting Tesla with both hands. And now let's move on to conclude this video. I want to share with you a video that Sven Henrich on Twitter posted about Jim Cramer, explaining the overnight pumps in the market. Remember that we call it the mysterious entity that is pumping the market overnight. But Jim Cramer here, this is back in the day, by the way, so he uncovered some gold mine here. Because if you thought that Jim Cramer was the good guy, here is a reminder that Jim Cramer is a piece of shit and he has a special place in hell. But he explains to you very well, in a very honest fashion, how the market gets manipulated overnight. So take a listen.
Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it is a very quick way to make money and very satisfying.
Okay.
Well, by the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
And here is the proof in the pudding. Since January of 2019, the gains in the market in the SPY from the trading hours, meaning the legitimate trading session of the day, we are pretty much flat since January 2019. If you bought the SPY at the beginning of the day and you sold it at the end of the day, every day you have not made anything. So how come the SPY since January of 2019 adding over 40% gains? The reason is the overnight pumping. It is a rigged market, and if you are too arrogant, thinking that you, retail traders and the Robin Hoodites, figured out the market and you put your blindfold every day and you buy calls, remember, it is the big guys who control the market. The market is only going up because the big boys are letting the market go up. There's gonna come a moment where the market becomes overheated and too expensive. They want to take some money off the table, and they're going to decide to pull the rug and hit this market down, and you're not gonna be able to do anything about it. Matter of fact, you're not going to see it coming. You're actually going to think that it is another dip to buy. And this is how the final burial happens. And once they shoot the market down and flush all the retail participants out of the market, these big guys use their cash, they buy the market again, and they create another cycle of boom. The rich getting richer, the poor gets poorer. But let's move on to the outlook for the week and what we have on the agenda tomorrow and what to expect here. Let me talk about some important things here. And here's a tweet that I talked about the market activities today. I said, today's action of buying the market pre-Fed meeting on stimulus optimism makes the market more susceptible of disappointment if, number one, they pass the stimulus, but the stimulus doesn't have $1,200 checks, or it is a split stimulus, a mini stimulus. That would be the ultimate seller news event. Furthermore, if the Fed tomorrow, and by the way, the Fed has been receiving a lot of criticism recently, not directly, but you're hearing a lot of celebrities and a lot of economists and big names talking about the contrast between the gains in the stock market and the real suffering in the economy. Now, you could say that the Fed is out of touch and it will continue to issue more cocaine for the market. But I think that the Fed has come to a moment here where they realize that their power is limited to fix things in the real economy. It is now on the lap of the federal government and fiscal stimulus to help the actual economy. The Fed has done enough for the stock market. The Fed has achieved its objective of quote-unquote market functioning and then some. They've overdone it due to retail participation. So my prediction here for tomorrow's meeting, remember, we have the vaccines ready. We have every economist, every bank, every Wall Street firm upgrading the outlook for 2021. And we have the stock market at all-time highs. Do you think the Fed is going to add more coke to the market? Or is it going to say, okay, the temporary lending facilities of liquidity are going to be shut in March or whatever date they give? That would be a bad news for the market. The market would suffer withdrawal. Why? Because the market is a cocaine addict. Never forget this fact. Now, the Fed might be out of touch and naive enough to say that no, we're going to keep and extend some lending facilities because we're seeing some weakness pockets in the economy. That would be very good for the stock market. But again, I'm very suspicious today about the market's activities because go back in 2009, back when professional traders were leading the market. What did we do back then when we wanted the government to pass stimulus? We intentionally crashed the market in 2008. And right away, within 24 hours, the government passed the TARP package. And every time we were reaching a very critical Fed meeting, we would intentionally sell off the market, creating red day to add pressure on the Fed to keep the easy policy going. This is not your father's market anymore. Matter of fact, it's not your big brother's market anymore. It is your Robin Hoodiot market. What are the Robin Hoodiots doing? Instead of putting pressure on the government to pass the stimulus, they continue to buy on quote-unquote stimulus optimism, meaning delaying the actual stimulus is actually good news from them. And they pump the market higher before going into the Fed meeting. By the rumor, by the news, by the aftermath, until it fires back. Could it be that tomorrow is the day where the Fed sees the vaccine news and the stock market all-time highs and they decide to pull the rug on some of the lending facilities? That would be a very disappointing factor to the market. So we are heading to a very critical day in the market tomorrow. Don't forget, it is quadruple witching week. There's a lot of shuffling going on. You have not seen anything yet. The action is just starting and it will heat up significantly starting tomorrow. That's all I got for you today, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.